wanted to welcome you guys to our asset management section of the Multifamily Matrix. Thank you once again for spending your Thursday evening with us. We're going to get into the first portion of asset management,
Welcome you guys to
which
our
is
asset
key.
management section of the multifamily matrix.
Uh, we're going to get some key formulas that we're going to go through. And so, B, I want you to kind of introduce this segment. I'm going to just move forward in some of our slides here. So let's go ahead and break down asset management as a whole before we get into the key formulas.
Yeah, so the distinction between the two is something that's extremely important as we bring everyone along in their career path. As everyone uh, in our group, are owners and operators of multifamily assets. It's important to be able to focus on management, the operational side. And when you do that, you have to have, two skill sets. You have to have property management at the operational side, and you have to have the asset management skill set as well. And so what we're doing is we're a deep dive now for 10 weeks. We're in a deep dive in our skill development um, monthly call or weekly call, um, a deep dive into the skill sets of an asset manager and being able to clearly identify the differences and the nuances and the similarities between asset management and property management. So we're all clear. But the main goal here is to for everyone to develop their skill sets as an asset manager as they take their certification, asset management designation inside of the multifamily matrix. These are just um, additional, as the name indicates, skill development weekly calls to be able to really brush up 10 weeks of really getting into core fundamentals and skill sets of an asset manager.
Excellent. And so we're going to break down a bit of a trichotomy here. Would love for you to kind of break down the difference between and the where they all align: portfolio management, asset management, and property management.
Right. So, your portfolio management, typically none of us here are dealing with a portfolio as large as I dealt with in the multifamily industry. So you primarily will take that portfolio management and substitute that with ownership. Your limited partners are ownership, and typically the asset manager, um, as we talked about last week, the is a division um, of the actual general partnership. So the general partnership typically will have an asset management component. The asset management is then, as you can see there in the third bubble, oversees, sets up, as we talked about again last week, the asset manager's job is to create what is known as the management plan for the actual property. So the playbook, and then it's the property manager's job to execute on those plays. And so, what is that? How does the asset manager set up the playbook? What is in the actual playbook? What plays are we running? How do you set up a management plan? What are the task, jobs, and skill sets of an asset manager? And then what is the process of overseeing the property management entity to make sure that they're actually executing on that? So typically you have individuals, general partners creating a syndication or a partnership, buying a multifamily asset, and then hiring third party a property manager. What I'm saying is, and what we're teaching is we're training individuals to, that's fine if you want to hire a third party property manager, but you as the asset manager, i.e. the general partner, the owner, you need to set the tone. You need to come up with the management plan. And that is typically done during the underwriting process. The management plan is pretty much developed during that process in the first week of acquisition, and then handed over to the property manager as the playbook on how that property should be ran and maintained. It's the asset managers, the general partners. If they've obviously promised a return to their limited partners. You don't want to hand your assets over to a third party, second party property management company, and then have them be totally dependent upon whether or not the goals are met. it's the general partner. The buck stops with the general partner. So that is why the general partnership should have an asset management component. And in order to do that, you really need to understand, as you said, the trichotomy of what that looks like. What does that framework look like? And so this is kind of an example of how they all interact.
Excellent. And thank you for breaking that down. So now we
So
want to
remember, articulate, implement, execute. General partners, you articulate the goal. Asset managers help to implement it and come up with the plan. And then the execution is done by the property management company.
Perfect.
The operations.
I'm sure that helps to clear up a few questions on, what the difference is. And so let's take a deeper dive into the whole asset management process. Would love for you to break this down, starting with acquisition, support, and then just going around. Give us, your opinion on, the importance of each of these sections.
Right. Yeah, all equally important. But this gives you a really, last week we showed you the table of contents of our certification program, which was cumbersome. This week, I kind of wanted to use a diagram to kind of basically show you, every level, every, I don't want to say chapter, but every skill set that an asset manager is going to cover and our program will cover. So you can see there's 10 different circles, 10 different bubbles. Each of these bubbles represent a skill set, right? And the asset manager, and it might take 3 or 4 types of skills to master one of these skill sets. So you've got, let's start with business, our acquisition support. Then you have business planning, team leadership, budgeting and approval, CapEx, lease approvals, operational efficiency, market research, financial analysis, disposition analysis, surveillance and reporting. These are all various different skill sets that an asset manager is responsible for. Any one of these bubbles can take up an entire day. So these are a lot of, the asset manager has to keep all these balls afloat. So there's a ton of tasks. So at the end of the day, the burden is heavy on the asset manager, but that's why we're going to do a deep dive, Nathan, and why we're going to break down the skill sets of the asset manager to so it's not so cumbersome or overwhelming, to our members.
Excellent.
Because that's a lot. That's a lot.
It is a lot.
You look at that circle and you go, man, I'm slap in the middle of that. I'm the asset manager. I'm responsible for keeping all those balls in the air. Absolutely. That's why you get paid the big bucks as a general partner. It's not as easy as a lot of folks make this out to be. Oh, buy multifamily. Oh, just hire a third-party property manager. You own a property in 100 days or 90 days or 30 days, you can own multifamily. Listen, man, I would love to buy into that philosophy, but the truth is maybe in certain economic cycles, but a lot of folks have been swimming, naked, and we haven't really seen because the tide hasn't rolled back, i.e. the market has been really well and performing. But, you'll get to see when the market shifts, October, November, you'll get to see who's swimming naked. And a lot of these philosophies of just handing your properties over, buying assets and handing them over to third party to the property managers, you'll begin to see, a lot of the holes in those theories where, you really have to, in order to steer this ship properly and get it from point A to point B and to be able to navigate, especially in, headwinds, forecasted headwinds, it's going to take you're going to have, each one of these bubbles that you see here mastered.
Perfect. So what I want to do is dive into some of the key formulas and would love for you to break down what is the importance of each of these.
Yeah. So what we're going to do today, what I wanted to do today is kind of prepare everyone before we go into those 10 circles, just kind of prepare everyone what some of the things that asset managers really must know. So right off the back, one of the things you're going to learn as you take the certification course in the next month or so within the multifamily matrix, you guys are going to, quickly understand that the ability to kind of understand some of these formulas that you really don't, a lot of these formulas are really not shared, Nathan, because, it's not IRR, cap rate, net present value. It's not as sexy as evaluating a multifamily asset. This is like where all the hard work comes in. Nobody wants to talk about these formulas, but these are the formulas that are used to operate and maintain a property on a daily basis, not just to evaluate one, which most books and most training boot camps or whatever, most of those, they focus just simply on the acquisition. These formulas come into play when you actually own and operate the property. So annual turnover percentage, you have, total number of annual physical move outs divided by the total number of apartments that will equal your turnover percentage. So, an example of that is assume you have a total of 360 units and a total of 295 physical move outs. Calculate the annual turnover as follows: is 295 divided by 360 will equal a 82% turnover. So understanding your turnover is going to be able to quickly, as an asset manager, when you have this on your dashboard, on your spreadsheet, you're quickly able to look at your numbers. When you get your weekly reports, you're quickly able, or your accounting month end, you're quickly able to make decisions and quickly see how the property is actually performing.
Excellent. So I'll keep it moving.
Another formula, average effective rent. So if you have, 42 units at 495, 270,000, 20,790, 58 units leased at $525 a month. You're looking at an annual revenue of 30,450, 94 units leased at 565. So you add all those up, at the end of the day, it gives you your effective gross average rent. So this formula is used to be able to look at and see exactly, what the effective averages are for, when you have a certain unit mix and you have various different rent schedules within your portfolio. This gives you the actual average. So what you see a lot of asset managers put this in their spreadsheets or they usually have a dashboard, and they use particularly all of these formulas that we're going to cover today within a spreadsheet to be able to quickly look at, again, an overall quick snapshot of the property's performance.
Excellent. All right, let's go ahead and keep it moving. Here we go.
Yep. And annual average.
There we go.
Yep. Average renewal increase. So you can take the average effective rent for renewals, average effective rent on previous lease percentage equals the amount increased divided by the previous lease. So basically what that tongue twister involves is the effective rent paid for the previous lease. Let's say it's $470. The effective rate paid for the renewal lease is $505. The renewal equals 505 minus the 470 equals $35. 35 divided by 470, 7.5. So this shows you your increase. So by percentage, it shows you the increase as a percentage in the actual rent schedule. So right now you're saying, for us, by what percentage have we either decreased or increased our renewals? And right now we had a slightly decrease starting in March because of the effects of COVID. We started to kind of want to compete in the marketplace, as well as we've seen an influx in new inventory coming into the market, which kind of at that time, March, April, and May, kind of stymied our traffic. And so what we had to do is lower our rental. We were right at 1,000, and we've lowered by 4%. We've lowered our net average in our rent schedule. So we're slowly but surely ticking back up right now in the summer months, which is a great positive that we see, especially during the COVID-19 crisis. But again, these percentages help you quickly understand exactly a snapshot of how you're performing. And then average square foot, we don't have to spend a lot of time on that, but this is a formula quickly that helps you understand your average, obviously your average square foots per unit mix. It's a formula that is used. Most of us hear about these formulas, but we really don't know unless we've Googled them. We really don't know, how to use these formulas. So that's why I believe this session is so important, because to be able to see the formula and to be able to see an example, this is something that you all can begin to start studying now and developing these skill sets. And then we can bypass the capitalization rate. I think we all pretty much know the cap rate. Closing percentage ratio is one of my favorites. So the total number of leases for the week divided by the total number of traffic will equal your closing percentage. This is a great formula to kind of really understand where your team is at and how, and as far as their ability to close, because everyone's like, how is leasing? Oh, it's great. Okay, what does that mean? How's leasing? Oh, traffic is picking up. Okay, as an asset manager, that's great, but those are not really those are not numbers. We can't hang our hat on that. So what do we need to hang our hat? We actually have to have those closing ratios. So assume you have 16 visitors, right? i.e. traffic to the property for the week, and you have 4 of those leased. Assume one person was previously shown an apartment. Calculate the closing percentage ratio as follows. So 4 divided by 15 will equal a 27% closing ratio. This gives you an idea of how good the team is actually closing on that traffic. Very important. This is something that I'm looking at right now. We got a ton of traffic. That's great. How much are we actually closing? And when those numbers are low, something's wrong. If we got a lot of traffic, but not a lot of folks are closing, something's wrong. For an example, I had a lot of traffic on one particular unit. It wasn't closing. Then its closing percentage ratio was extremely low. And so for this particular unit, Nathan, so, I had to start asking, making sure that our team guys ask, why are the individuals not renting? We need this information. And so finally they started asking, and a lot of individuals complain about the lack of light, that the unit was actually up front. They loved it, but there was a lack of lighting. So, when we started asking why individuals weren't renting, or even had called some of the ones that said no previously, I liked it, loved the location, but that particular unit, let me know when something else opens up. I had our team call those individuals back and ask them, can you give me specifics why you chose not to rent? Understanding the demographics and psychographics of the prospect tenant is so important. And this is a prime example. A lot of them complain about the lack of lighting, and this has wall-to-wall lighting or windows in this unit. Well, guess what? Park Plaza, Nathan, we've got those beautiful palm trees and banana trees right up front. Great curb appeal, but it's blocking this particular unit's view. So what I had the team do was go in and cut a lot of that back, a lot of those banana trees and and trim the palms to let more light in. So hopefully that will work. But how do you know these things? Because you need to ask. But even then, I was, how was I triggered that there was something wrong? I talked to Danny last week about how a doctor goes in and uses a physical and the questionnaire to kind of get to, what's going on. Are you running a fever? They can ask certain questions to kind of figure out, is this a virus? Or or is this just a bug? And that's kind of what I do when I'm looking at these formulas, is I'm figuring out, is this a virus or is this a bug? And then I'm able to prescribe. But you can't prescribe, you're just guessing if you're really not able to catch this. And to be able to catch it early is key, because you're doing your weekly Monday morning reports. I'm able to catch this. I'm able to see how much traffic we had that week. I'm able to look at how many units we've closed. And then when I see these low closing ratios, I'm able to identify an issue or a problem with particular units, down to that, changing and making some adjustments in the landscaping. I mean, that's pretty damn accurate. That's pretty precise. Cost of advertising. So assume you have an in-place ad on Facebook and it's running you right around 5,400, right? The ad generates 32 leases. You want to calculate and know, your capture rate. So 5,400 divided by 32 will equal $168.75. That's what it's costing you per lease. This is good to know when you're running ads on Facebook or social media or Zillow, because Zillow now in a lot of regions are charging, to list and post your rentals. So this is a good idea to kind of understand where you're spending your marketing dollars and how much that signage is costing you. Are you seeing any return on investment? So it's a great way to understand how to, obviously when you're also doing your budget, but this is a great way on a weekly report, to understand what the return on investment is for your ad campaigns for that particular property. Really, at the end of the day, I'm spending what, $5,000 a month or a year? What's my rate of return? How many leases am I getting out of it? And that's important to know. How much you're spending and how many leases are you actually capturing because of it. All right, Nate.
Oh, sorry, I had us on mute. So I was just pulling up the next slide here. We had a couple more metrics here. Our cost of advertising per traffic.
Cost of advertising per traffic. Assume you have placed an ad, again, Facebook, social media, Zillow. 3,800, 58 prospect tenants respond. Calculate the cost per traffic as follows. 38 divided by 58 will equal $65 per piece of traffic. Again, really important. These numbers are big because we're talking multifamily, but this is huge as we begin to understand that, companies like Zillow are now charging, so how much are you actually making when you spend $5 a week to advertise on Zillow, your rental property? What is the return? How much traffic are you getting? I'm still doing Zillow as well as Facebook because Zillow is it's producing a lot of traffic for me, and it's getting results. How would I know if I wasn't able to use these formulas to track that? How do I know that $5 is not too much, or you don't know until you actually have these matrix and you're using these formulas to track. So it's really important. Economic occupancy percentage. So to calculate the economic occupancy percentage, you want to divide the total rent revenue by the gross potential rent. To first determine the rent revenue, you want to minus out your vacancy loss and collection loss. So current month gross potential rent, 250,000 per se. Non-revenue units equals 52,000. You want to minus that out. Total rent revenue equals 198,000. 198,000 divided by the 250 will equal 79%. 79% economic occupancy. So this is basically telling you what your economic occupancy is, which is far more important than physical occupancy. So who's paying rent? How many people are staying? And that's important right now. This form is extremely important in COVID. Why? Because there's going to be a ton of individuals that claim their property has 95% occupancy, Nathan. But their economic occupancy may be well below 68% because every tenant, let's just say 3 out of every 5 tenants right now are not paying rent. And you cannot necessarily get rid of them, right, until September in the state of Florida because all evictions and foreclosures have been paused. And trust me when I tell you, you think the end is September. When September comes, it's going to be pushed into October and November. And then even then, during the holiday season, you can pretty much forget trying to get an eviction done until the 1st of 2021. So, understanding the difference between physical and economic occupancy is going to be extremely important in your underwriting, as well as extremely important as the asset manager when you're looking at your Monday morning reports. You want to know exactly what you're actually collecting. not just your physical occupancy. You know, to say, oh yeah, I'm 98% occupied, you would think everything is hunky dory, but your economic occupancy showing 67%, or in this particular scenario 79%. And with my spreadsheet, it'll show you what percentage you need to be at to be able to cover your mortgage, property taxes, and all of your major bills. So it's extremely important, really important to understand that.
Absolutely. I was going to ask you that question because we do see a lot of people, saying, yeah, my unit is or my property is fully vacant, or not fully vacant, but fully occupied. We've also got people that are probably going to be trying to get rid of their units. And yeah, they can try to throw that number out there.
Yeah, we're 95% occupied. Yeah, that's great. What's your economic occupancy? That's the answer. That's the question.
So those are all the formulas, B, that you had ready for
wow.
today. Yeah. Well done. So we knocked that out in about 30 minutes. We kind of want to open up the floor for Q&As now, man. It'd be kind of great. If anybody has any questions about the formulas.
Yep. Candace had a question. I see. Yes, Candace. It's actually on Facebook Live right now. So we've already beat you to sharing it with the world. So yeah, feel free to grab all this and share it. But the most important thing, guys, this is just, I wanted to throw this out there. And all these formulas you guys are going to have inside the new multifamily matrix. It's going to be in your spreadsheet. I'm having a special asset manager dashboard built out on the spreadsheet that I use. So your spreadsheet's going to be able to handle complex waterfall structures, budgets, rehab budgets, and now you're going to have an asset manager dashboard with all these formulas in it. They're going to help you quickly evaluate your property on a weekly basis. I call it Monday morning reports. So when you get your Monday morning reports, and then at the end of the month, we call it AME, you get your accounting month-end reports. You're able to look at a lot of these matrix and kind of really quickly diagnose the health of the properties and be able to help the property managers perform better.
And these things will shift with what's going on, like right now, for example, because now physical versus economic occupancy is going to be huge, and also evaluating what the insurance is going to look like for the property is different. So those types of things will be updated as things in the economy evolve, et cetera, et cetera.
Traffic as well. So understanding how much traffic you're getting, I think to me is going to be probably one of the most important formulas, is being able to look at that traffic and be able to understand that closing ratio. So if I'm getting 5 or 6 pieces of traffic, I'm only closing, getting 1 or 2 pieces of traffic, or 1 or 2 leases. What are we doing? What are we not saying? A lot of this is, if you see, I'm putting wood floors in, the laminate wood flooring in a lot of our select units. I've been forced pretty much to do that, to be able to keep up with the influx of new supply from Class A properties in the downtown St. Petersburg market. So a lot of my former competitors that we laid waste to in the first 2 years are starting to catch up with remodeling their units. So being able to stay consistent and right just beneath that Class A. I'm not so much worried about our competitors who directly compete with us in the market, because I feel like our management as well as our location is indisputable. But when you're talking about Class A properties and the amenities such as coffee and computer rooms and weight rooms and sauna and spas and movie theaters, all the things they throw at these individuals, you got to be able to maintain. And, especially right now at the price points that they're putting this product out, with waiving 1 month's free rent, things of that nature, and all the free giveaways that they're doing, it's tough. And that's why I'm always looking at these Monday morning reports and making our adjustments. I'm always constantly making adjustments. It's just like sports, as an analogy, football, you're constantly during halftime, but even each possession you're looking, you see when you go to the sideline, if you're a big football fan, you know how those quarterbacks are always going through those snapshots, satellite snapshots of the play field, so they can see what the defense is doing. And they're going over that with the defensive or the offensive coordinator, to understand where the holes and the weaknesses are in the defense. and then they come back out and they make adjustments in their play calling. And that's really what Monday morning reports for asset management is all about, is looking and making these adjustments. This is constant. And this is something that, this is why I totally disagree with buying multifamily and then just handing it over to a property manager, that you've got to know this in and out. You have to have more skill sets than the property manager. You have to know, you have to know every aspect, all those circles that we looked at that the asset manager, all those skill sets that they have to have. You have to master these. It's imperative that we do in order to be able to guide this ship. And guys, when I tell you, we've got some headwinds to come. So for those of you who are currently operating right now and have assets, and you think you've scathed and you think COVID hasn't really hit us hard. I'm trying to tell you, and I've been saying this from day one, Candace, you sent me something and I kind of, and it confirms my hypothesis. When I did some COVID-19 market predictions, and I said, give us 90 days. And then at that time, I told you, I don't think the real true tale of COVID-19 will come out until October, November. You're going to see some tough times in October, November for a lot of operators. So not having the skill sets to be able to navigate and bring your ship in from these high seas and bring them into port, bring these assets into port, it's going to be tough. It's going to take a special type of operator to be able to weather these storms and bring these ships in safely. So, you can learn it now or you can learn it later. I will promise you, learning it later is going to cost you more money.
Definitely. Hey, Bryan, I got a question.
Yes.
Hey, when it comes to advertising, we've been advertising on Google, I would say probably for the last 6 months, but we've been economically 100% occupied. Does it make sense if you're economically occupied for at least 3 to 6, maybe 9 months to continue advertising?
That's a good question. My gut instinct is never to answer that type of question until I've seen all of your reports and I've seen your rent rolls and I've had an opportunity to sit down and talk with you and understand the demographics and psychographics of where this property is located, understand the demographics and psychographics of your tenant base. And then I make a decision and it will help you make a decision. But with that being said, if I had to give you a knee-jerk reply, I would say if I'm a couple of things, if I'm 100% performing economic occupancy, my first indication is to say my rents are too low.
Right.
Second thing is to definitely probably look at our advertising and say, okay, if we're doing this well, and I feel like we're maximizing our economic occupancy, we need to push the rents up. So my knee-jerk reaction would be to start raising the rents. Therefore, raising the rents would create a vacancy. And so you would need to lean on that advertisement. So, right now I would have to then look at and probably have questions and say, okay, let's find out where the majority of our traffic is coming from. Can we get the same performance out of traffic by doing a Facebook marketplace, which is free, versus Google? So, or Zillow for $5 a lead and just post one unit up there and leave it up there for every week. Even if it rents, we just use it as our model unit to put on Zillow every week. And when people call, it's used as a traffic generator. Can we do that? So, again, without really looking at your Monday morning reports, it's really difficult to say. But my main thing would be to say, I would like for us to evaluate your rent schedules right now and see if we could slightly get 3 to 8% increase on your monthly rents, on your rent schedules. So if your rents are $750 for your 1 bedrooms, I'd like to see you try to get 3 to 5% on the next renewal.
Well, here's the kicker, because one of the markets we're in, we're probably 60% higher than the market rents for our 1 bedrooms. And that's the crazy thing. Like, we rent them out really fast, and we've been raising. We haven't been lowering our rents. We've actually been raising our rents, and a lot of the other 1 bedrooms in the market are not. They're just staying steady, at whatever rents they've been for the last 2 years.
Well, then, like I said, as long as we're at that 100%, I'm gonna keep saying raise.
Keep raising. Okay.
Keep raising. Keep raising.
Does it make sense to raise?
Nathan has something he wanted to add. Was it as an advertiser, Nathan? Go ahead.
Yeah, absolutely. So Malik, I would say, sorry, I'm getting a little echo here. You're going to want to always keep your advertisement on. You want to show up when people are searching for properties in your location.
Okay.
And then you also want to show up for your reputation. So as you're collecting stars and you're having that 5-star experience, you want to make sure that you show up organically. You want to show up because of your reputation. And if you can take over some advertising spaces, you're going to want to do that as well. Because if you don't advertise in that space, other apartment complexes will start advertising. They're going to show up and start poaching, leases. So you want to just kind of keep that full court press, and then bring the cost down by, collecting stars, making sure your SEO is tight. And so you reduce the reliance of paid advertising, but you still want to keep it up there for impressions. And if you can dominate all those different spaces, you just continually show up first. You might persuade someone to hold off for another month until you do actually become, you have a vacancy. So if the cost is right and you're not burning a lot of cash, then it makes sense to advertise in that space.
Good advice.
That's powerful. Great advice. Thank you, Nathan.
Do we have any other questions?
Yes.
Jacob said, does it make sense to use a combo of slow raising rent and a wait list?
Say that again. Who said that?
Jacob.
Repeat the question again. I'm sorry.
Well, would it make sense to kind of implement some sort of waitlist strategy and just move the advertised price up? But with him having so much popularity and so much success, to test out the market and see if people are still willing to come on a waitlist type of thing, where you can get that direct feedback, and then maybe switch out tenants over time as leases expire if they not want to renew at that higher price.
Yeah, absolutely. A waiting list is, if you're in a hot market, as it sounds like Malik is in, then obviously a waiting list makes sense. Have I found waiting lists to be effective? It's kind of hit or miss. It's a tool that our leasing agents use. I'd honestly, as a former leasing agent in my past, many moons ago, did I feed off of that waiting list? No. The majority of the time when I called somebody, they already found a place, and if the number still was good, it was. But it's all, waiting list is always good. I think with Nathan's strategy is probably the best, and just really understanding that if you're 100% occupied, I would keep pushing my rents until I got somewhere. I'd like to see us right around 95, 97% occupied.
So Bryan, and this is the thing, because that market is like a smaller market, a tertiary, and I've been testing the market since we bought the complex, and I really didn't think we would get to the point where we are now in rents, because when we came in, everybody was like at $350 a month. And, we did a total complete rehab of our unit. So we went to, I think we started off at 500, and now we have maybe a quarter of our units at 6, and then all the rest of them are around about 550. So I think I agree with you, just pushing the envelope to get them all at 6. But it's been kind of crazy, because like I said, we're testing this smaller market, and is actually paying off.
Well, you know, and it's not, it's, you know, it's, and I'd like to take credit for it, but I'm not, you know, I don't want to take credit. I mean, it's not me. It's again, it's these formulas. It's this dashboard that's telling you your rents are too low. So it's not me. I'm showing you guys these formulas. I'm showing you the techniques that an asset manager uses. You know, I think a lot of people, you know, they really get excited and you know, they give me far too much credit when I predict or I predict cycles, or I'm on a podcast and I make certain predictions and they come true. But really, guys, at the end of the day, these are my cheat codes. I'm showing you guys my cheat codes. All I'm doing is just simply following along and understanding what these stats tell me. And like a good chess player, I make my adjustments. So if I see you're cheating, beating, your defensive backs are cheating, and you're playing me up close, and you're playing the run, then I'm gonna slide in the tight end, and I'm gonna, you know, make some certain adjustments, and free up certain parts of my offense, you know. But if I'm not looking at these stats, or I'm not looking at those photographs on the sideline after every possession and making adjustments, constant adjustments, then, you know, you're just going to keep getting beat. And that's kind of how it is in running a property management company, or running a portfolio of assets. You're going to keep getting beat. And I think a lot of folks, you know, they haven't been beat because the market's been so good. So they haven't had to develop these skill sets. And so they don't have them. You know, the market has been carrying a lot of individuals. And like I said, I mean, you know, that's, if you're not inside the multifamily matrix because you want the market to carry you. You actually want to understand how to predict and how to forecast. And this is where it's won and lost. So I can't take credit. I simply look at these cheat sheets and these statistics, my dashboard, and I make adjustments. If there's any brilliance in what I do, is I make adjustments at the right time, you know, to score and to move the ball. You know, first down. Eventually I'm in the red zone and I'm threatening to score. So, you know, that's how I kind of, you know, I'm not necessarily always looking for the bomb play. I'm, you know, I take it's a play at a time. I'm just looking to get a first down. So if I can bump the rents 3 to 5%, you know, I'm always, if I can reduce expenses, you know, then I'm making those adjustments.
Now, I got another question. This is really an acquisition because I just recently came from Dallas, looked at maybe about 15 complexes in Dallas. But what I noticed is similar to Atlanta, that is somewhat expensive and your returns are very low. So I guess my question to you is, and this is not just in those two locations, it's other locations that I've looked in. It's like how do you find that winning deal, or do you just sit and wait, like you mentioned earlier, until the market collapses?
So repeat that again, because my internet I must be having some issues. Can you just repeat that real quick again?
Yeah, I can repeat it.
Thank you.
What I was saying with me looking for deals in different markets, I'm noticing that it's a lot of deals that's overpriced. And like you've already mentioned, you know, they're not really pricing on income anymore. So like, what's the best way to attack trying to acquire a home run deal if everybody is just going off of the market doing so well? Or do you just sit and wait for the market to collapse before you acquire a property? Or do you just go to a hot market, buy low, and wait for the appreciation?
Well, the idea of going to a hot market and buying low is kind of an oxymoron, because I've never gone to a hot market and been able to buy low. But if you can do that, then by all means, then do that. You know, if you do find something in a hot market, it's typically distressed. And that's where you have to kind of open up your skill sets and be able to work on advertisement to get in front of owners and operators before they get to the commercial brokers and things are overpriced. As far as, where do you find the deals? What you have to do is I think for the most part, the problem is everyone is always talking about finding deals. I think if I had to really deep dive into my philosophy, is I'm not really looking at deals. I can't honestly say for one moment, and be honest with you guys, that I'm actually looking for a deal.
Okay.
What I'm doing is I'm looking at trends. I don't know, is Danny Farth on the call? Is Danny here?
No, he's not.
Danny's not here tonight. Okay. When he came, he's in my one-on-one coaching program. And when he came to Park Plaza to spend some time with me on site, he was asking me what I was listening to in my car. I was listening to the IMF podcast, right? Just understanding global markets. When you like, what is it that I'm saying? I can care less about looking at deals. I'm looking and understanding global markets, how global markets affect micro and macro. And then what I'm doing is predicting needs and wants, because I know housing is always going to be a huge need. So I'm kind of just really predicting markets and forecasting, opportunities in that respect. I let the deal is gonna come. So you'll know the deal. What I would like for you to do, Malik, is stop talking about deals.
Okay.
I'm looking at deals. I'm looking at this. I like to talk I don't have a lot of them, but the masterminds that I talk to, the individuals that are really skillful in this industry that I speak to, that when I go to coffee or I have breakfast in my circle, we're not talking about deals. We're talking about markets. And we're talking about how these markets affect the demographics and psychographics that we're targeting based upon our field of work, maybe a need like workforce housing. How is that going to affect? How is COVID going to affect? How is this how is, the stimulus package being held up right now and that $600 not getting to the folks in the next couple of weeks? How is that? What is that going to have? How is that going to affect the market? This is what I'm telling you. This is when you're going to start to see things come out in the wash. So I'm not really concerned about properties and assets right now. Those reveal themselves. You wouldn't know what it would look like if you're not really understanding how to focus on markets, micro and macro. You wouldn't know a good deal if it slapped you in the face, in my opinion. And even if it was a good deal, you wouldn't really understand if it could weather any kind of storm, because you haven't forecast. You're not a master of forecasting. What you're a master of is looking at brick and mortar. And brick and mortar don't pay rent. People pay rent. So I mean, all the talk about looking at deals, and multifamily has never been about looking at deals. I know that's what you get in social media, and I know that's what everybody writes books on, and everybody talks about it at a boot camp or a training, this or that is deals, but that's not what I learned in the multifamily. They told me from day one, bricks and mortar don't pay rent. People pay rent. Know about the market. Know about how the markets affect your target demographic. That's what I was trying to get, the point that I was trying to drive this evening. I did not know until I asked and polled our prospect tenants. These are not even tenants. These are prospects. They didn't give me a dime, but they gave me valuable information about why my unit wasn't renting. Not enough light. That cost me, Malik. Those units sitting vacant cost me, what, $38 a day? If it sits 2 weeks, do the math. That cost me. That unit not moving is costing me. Those hedges not being trimmed is costing me. But formulas are not telling me that. The brick and mortar is not telling me that. The people told me that. So just my point is that, this is where multifamily is not about all the brick and mortar, not all about the easy stuff, the easy shit that you can see at face value. It's about really understanding what makes multifamily work and how to, what components, what key components. Nathan, if you don't mind pulling up that asset management with all the circles, what key components really make a property run and what skill sets. That is what this is about. That is what I want you to get to the point of. Don't worry about deals, Malik. Those will find you. I promise you. Those will find you. Once you've mastered each of these circles and these skill sets, the deals will find you. You'll know how to suss out the deals, because these projects will eventually identify themselves. Eventually will identify themselves. So don't focus so much about trying to find a great deal and don't rush. Don't hasten the bloom of the flower. That's when you get problems. That's when problems occur. Master the skill sets.
Absolutely. That's why I'm in the matrix.
Love it. Hey, B, so we're getting to 9 o'clock right now. I'd love for you to give a sneak peek of next week. So we're going to go into acquisition support. Would love for you to just kind of let everyone know why that's important, why they should tune in next week.
Yeah, we're going to just talk about all of the, all of the major components that that encompasses helping an asset manager make decisions on the acquisition. So developing the management plan. So I'm really going to focus on the management plan when it comes to acquisition support, because we all know underwriting software. For the most part, I'm going to talk about the underwriting process. But we all get enough of that on every Facebook and multifamily meetup page or whatever. But what is not being talked about is the asset management plan. What is the playbook that's being created to be carried out once the property is acquired? So we're going to talk about the acquisition support from the asset management perspective, and that's really all about developing the actual management plan and putting the team in place around you, to be able to set up the acquisition.
Perfect. Does anybody else have any questions?
Yeah, this is Carlos.
Yes, Carlos.
Yes, I had a question on what is your thought on third party vendors?
In what respect? When you say third, as maintenance technicians?
No, having tenants coming in. Sample, if you have low you don't have too many tenants on your properties, they will get you the tenants that you need.
The lease up, some like the lease up teams.
Yep.
If it makes sense, usually they take 1 month rent.
It's a 10 months. The ones that I'm talking to.
They want 10 months?
Yeah, I mean, they will lease it for 10 months.
They will lease it for 10 months, but how much is the fee? They usually take 1 month's rent. If I lease that unit for you, I usually take the first month's rent.
2 months.
They want 2 months? Yes, I mean, if I don't use a lease up team. I've used them in the past when I worked in the multifamily industry, and that was only because it was new build, new development, new construction. I've never used a lease up team on an existing property. I've always been taught that if one person can lease it up, then I can lease it up. So my question is why am I hiring somebody to come in and do something that my team can do? So I feel if somebody can step in and lease up, then I feel like then the team that I got in place I need to get a new team in place. So first I'd like to figure out why we can't lease.
Yep.
Because 2 months rent, that's not cheap. It's not cheap.
All right.
Saying no, but just like what I told Malik, I need to see some more information. I would like to see the rent roll. So if this is an actual scenario, I'd like to
I think you misunderstand the question. It's this organization. They have people, for example, they come out of jail, they pay for the rent for them.
Oh, got it. Oh, okay. I thought you meant that. What do I feel about people
Yeah.
coming out, or work programs, or people that
Exactly, and the program will pay for them for.
yeah, not a problem as long as the program can be screened. Yeah, so that's like HUD VASH, Section 8,
Exactly.
HUD VASH. Then there's a couple of programs for prison release. That one I've had people approach. I've passed on that just because of the liability issues.
Yeah.
So I made an announcement on that with somebody, and I kind of got bashed on social media, but I'll take the negative publicity with it. They're like, oh man, you got to help people out of jail. And I get that. I have a soft spot for them, and I'll be glad to send them a free book, Buy It, Rent It, Profit, signed by me. But moving them on my property and taking a chance on those individuals is something that is entirely different. You're asking me to hedge my whole entire investment and the well-being of our other tenants on whether or not an individual has been reformed. I'm not willing to take that risk. I wouldn't take that risk with a family member of mine. So I definitely not taking that risk with somebody that I don't know fresh out of prison. So that's where I stand. You can bash me, you can say whatever you want, but at the end of the day, that's my stance. But if it's HUD VASH, former veteran, if the program is like HUD, a housing authority, I'm okay with those programs. I'm okay. I just kind of draw the line with the whole with the prison release one.
Got you. Yep.
But they're good programs.
Thank you.
Yes, sir.
My father-in-law deals a lot with, it's nationwide. It's a transition house. It's called The Transition House, and it's been around for 27 years now. They help homeless veterans and others get on their feet and remediate their life into steps to get back on the right track.
Mm-hmm.
And I have seen firsthand, my husband and I have done a lot of the rehabs, meaning physical, for the properties for him. So project management side of the business. And I can tell you that's taking on an awful lot. It's a labor of love. It's something you definitely want to do. You want to make sure you have some grant money involved whenever you're taking that on, because your properties will typically need a lot of work, and that's just the truth. And so that's what I have to say about that.
Yep. Well, thank you. Yeah, absolutely. So anybody else? 9 o'clock comes fast, doesn't it? I mean, most of us, we can go on for hours.
Man, I can stay on with you for a whole nother hour and talk.
I know, man. You get to once we get started, man, it's hard to shut it down at 9. But yeah, guys, next week is gonna be fun. We're gonna be getting into each and every one of these circles. It's gonna be fun. And then by the time we get to the end of the circles, we're already now gonna be inside the new multifamily matrix platform. So I'm so excited about that for you guys. And yeah, man, I'm so stoked. So I'll see you guys next week if there's no more questions. And if there are, then hold them for next week or just text me. You guys all know how to get a hold of me, to yourselves, to your businesses, each and every one of you. May God bless you. Continue to bless each and every one of you. And until next week, we'll see you soon.
All right. Good night, guys. Thanks.
Good night, guys.
Thank you.
Thank you.
All right.
Thank you.